Good day everyone, I am Kian Dicazon and today I will be discussing the important scenario involving a liquidity crisis in the Philippine banking system. We will analyze the potential economic impacts of the crisis, explore the tools that the Bangko Sentral ng Pilipinas can use to address it, and examine the possible trade-offs that might arise as the central bank takes action. And the scenario is liquidity crisis in the Philippine banking system. In the fictional year 2032, the Philippine banking system faces a severe liquidity crisis. Several commercial banks report difficulties in meeting short-term obligations due to a sudden increase in withdrawals by depositors. The crisis is triggered by declining investors' confidence after a global financial shock and rumors of potential banks' insolvencies. Businesses that rely on banks' loan for day-to-day operations are unable to secure credit, and smaller banks struggle to maintain cash reserves. As a result, economic activity slow down and fears of the broader financial collapse grow. Analysis of the scenario. A. Implications for the economy. There are three implications for the economy, which is reduced access to credit, bank runs, economic slowdown. Reduced access to credit. Businesses, especially small and medium-sized enterprises or SMEs, may find it difficult to secure loans, leading to decreased investments, lower productions, and potential job losses. Bank runs. As depositors panic, there could be a surge in withdrawals which may worsen the liquidity crisis and push more banks towards insolvency. Economic slowdown. With limited access to credit and decreased consumer confidence, overall economic growth may slow down. Analysis of the scenario letter B. Tools the central bank can use to address the issue, which is lender of last resort, lowering the reserve requirement ratio or RRR, open market operations or OMO, strengthening public confidence. Number 1. Lender of last resort. The Bangko Sentral ng Pilipinas o BSP can provide emergency loans to struggling banks to help them withdrawal demands and stabilize the financial system. Lowering the reserve requirement ratio or RRR by reducing the amount of money that banks are required to hold in reserve, the BSP can increase the amount of money available for lending, improving liquidity in the banking system. The open market operations or OMO. The BSP can purchase government securities from banks, injecting cash into the system and easing liquidity pressures, strengthening public confidence. The BSP can issue public statements to reassure depositors that their money is safe, helping to prevent further banks run. Analysis of the scenario, trade-offs that might arise. Short-term liquidity versus inflation risk. Injecting more money into the financial system could solve the liquidity crisis, but it may also increase the risk of inflation if too much money is released into the economy. Stabilizing banks versus moral hazard. Providing emergency loans to banks may prevent a financial collapse, but it could create a moral hazard if banks take excessive risk, believing that the central bank will always bail them out. Economic growth versus financial stability. While lowering interest rates and reserve requirements could stimulate economic growth, it may also encourage excessive borrowing, which could lead to future financial instability.